Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to the live stream. This is an important one, so stick around for this because what's happening today, literally today, Tuesday, January 20th, could be the opening salvos of a global financial crisis, the likes of which the world has never before seen in its whole history. This could be the biggest one yet. Okay, this candle that you're looking at on this chart, this is a daily chart of the yield on a Japanese 30-year treasury, which today is up by more than 8.61%. Okay, that's a huge move for a debt market in a developed modern economy. You know, this is the sort of thing you might see in the Zimbabwe debt market. And this is not going to play out without consequences for the global economy. It's no surprise that the price of silver today smashed through $95, putting in a new record all-time high once again. And this is not done. And I don't mean to be alarmist. I don't mean to blow this out of proportion. But, I mean, look at that candle on the yield of the 30-year bond in the world's most indebted developed economy, Japan, which also happens to be the largest foreign holder of U.S. treasuries. This could, again, be the opening salvo of a debt crisis that will make previous ones look like child's play. And I'm going to lay out in this live stream for you why the global economy is in worse shape to handle this financial crisis than it has been in previous episodes, and what that's going to mean for the price of gold and silver, okay? Because it has huge implications. And look, I can't give anybody financial advice. I mean, all I can do is share with you my analysis and my forecasts. Silver today, right now, is trading at $94.25, which is a record all-time high. It was up as high as $95.86 earlier in the session. Okay, so there's going to be volatility moving forward, but it's my forecast that we're headed to triple digits and much, much higher. I mean, now we're, $5 away from $100? It's coming. That's my forecast. And again, I can't give you financial advice, but if you want to get some physical metal before the global debt bubble implodes, which could literally be starting today, then check this out. SD Bullion, trusted by hundreds of thousands of customers, A+ rated by the BBB, home of the Scottsdale Mint Eagle Stacker Silver Round, precision crafted, interlocking in multiple sizes. Visit sdbullion.com where America buys physical gold and silver. All right, so SD Bullion, that's where I buy my gold and silver. And, again, I can't tell you what to do, but I will tell you that when I see what's happening in the Japanese 30-year yield, I would be very uncomfortable, very nervous if I didn't have in my possession physical, tangible assets without counterparty risk that don't depend on a counterparty in the global financial system to deliver value. Okay, I mean, what's happening in the bond market here, it makes me think of, Bill Paxton in Alien. That's it, man. Game over, man. Game over. Who else likes Bill Paxton? R.I.P. Love that guy. Let me share with you this infographic, which I created to kind of explain what's happening today with the Japanese bond market and why this is so important, right? So it's very unusual to see a bond yield in a developed economy moving up 8.5% in one day. But that's exactly what we saw today. And again, it's not just their 30-year yield, the 10-year yield up over 3%. That alone is a huge move. And this is such a big deal because Japan is the number one foreign holder of U.S. debt. So if you're in the United States, if you save in dollars, if you earn dollars, and you say, well, this isn't going to affect me because it's in Japan, this absolutely could have knock-on effects very soon in the United States because they hold over $1.2 trillion of U.S. debt. Now, what does that mean? Well, they're sitting on a pile of our debt. Right now, investors are selling Japanese bonds, right? Because they are worried about inflation in Japan, which is rising. They're worried about their indebtedness because they have a massive level of debt. I believe their debt to GDP ratio is over 200%. The Japanese central bank is not going to want to cut rates in this environment to try to get things under control because they're already feeling the inflationary effects of previous rounds of quantitative easing by their central bank. So they're not going to want to print yen out of thin air to buy bonds to drive their yields down. So what options do they have? Well, they could sell their U.S. treasuries to try to defend their bond market. And again, they are the biggest foreign holder. You don't have to take my infographic on face value. This is from the Treasury, Table 5, major foreign holders of Treasury securities. There's Japan, right at the top. And you might notice there's a bunch of European countries on this list too. We're going to talk about that in a few minutes and why the stage is really set here for a perfect storm for a sovereign debt crisis in the U.S. and worldwide, which may very well be starting today in Japan. All right, so if they dump their U.S. treasuries, are investors going to flock to these U.S. treasuries to buy them? No, because we're already seeing yields rise in the U.S. too. Look, today, 10-year yield in the U.S. Earlier in the session, it was a bit higher than it is now, but it was up. It's up right now, 1.09%. You can see it gapped up overnight. The yield on a U.S. 30-year Treasury also gapping up at the open, up 1.24%. And the way that bond yields work is if buyers come into the market, then the yield goes down. If investors sell U.S. treasuries, or if the Treasury dumps a bunch of treasuries, meaning they borrow a bunch of money, that makes yields go up because you need to incentivize buyers to come into the market. Now, soaring bond yields in the U.S. is a problem in and of itself because we have a debt crisis that's been playing out here for the past several years. The interest cost on the massive U.S. national debt, which is now over $38 trillion, has exploded past $1 trillion annually. So we actually need to do everything we can to get bond yields down. That's why President Trump has been putting pressure on the Federal Reserve to cut rates more aggressively. It's also why the Fed recently announced the resumption of Treasury purchases and the expansion of their balance sheets, known as QE, quantitative easing. That's when the central bank prints currency out of nowhere and uses it to buy bonds to drive the yield on the bonds down, allowing the debt service cost of the government to go down. But the problem with that is it massively debases the currency because the central bank has to create that currency out of nowhere. And that means that the money supply increases, and the real definition of inflation is the expansion of the money supply. It's not prices. I mean, if you go back to a dictionary from the 1970s or earlier, the definition of inflation is the expansion of the money supply and of credit, which can lead to higher prices. Now, they changed that conveniently in the 1970s. Interesting that they did that right at the same time that Nixon ended the convertibility of the dollar into gold. But I mean, I'm digressing here a little bit. This is all very relevant to what's playing out before our eyes right now, though. So if Japan decides to dump their U.S. debt for liquidity, that means that the Fed is going to have to ramp up the money printing to buy that debt to prevent U.S. bond yields from soaring. Okay, massive inflation occurs, and then silver over 95 suddenly makes a lot of sense. That was me saying that. I was the analyst, because if you're wondering why silver is smashing record all-time highs and why the trajectory of silver, it looks like this, then here's your answer. It's that the global debt bubble is potentially about to pop. And that means that there's going to be a lot of dollar debasement. It's the only way, right? The two options, I suppose, are that the governments could default on their debt obligations. That would be a huge problem in and of itself. or they can print money to pay off their debt in devalued currency. That's the route they always choose. That's what's coming. And that's why the price of silver is over $94 right now. That's why gold, look at gold, okay? Look at that. We had this consolidation we've been tracking. I mean, I didn't just draw these lines. We've been watching this for a while. If you follow the channel, you know that we've been talking about this for a long time. Well, today, gold is at a record all-time high, above $4,740. Okay? That's because investors know that what's about to happen is dollar debasement. Gold to silver ratio today briefly dropped below 50. Pretty interesting. I think this trend is going to continue. We're going to see the gold to silver ratio drop as this plays out because silver tends to outperform gold in a bull market. I mean, you're seeing it today. Silver's up 4.38%. Gold's up 3.24%. Although gold has been kind of trending sideways for a while, and I think we are about to see a big move in gold, but we're going to see a big move in silver too. Now, why is now such a bad time for all of this to play out? Well, let's talk briefly about previous instances of global financial crisis. And, all you really need to do is look at this, the Fed balance sheet, to get an idea of the timeline here. So in 2008, we had the great financial crisis. The Fed began QE in earnest, began printing money, buying U.S. treasuries, trying to, quote unquote, stimulate the economy in a Keynesian economic kind of way. And I mean, yeah, I guess if you want to call inflating giant asset bubble stimulus, that's what they did. They kept printing. They kind of resumed this with QE2 here, expanded the balance sheet up to over $4 trillion in the center of the previous decade, the middle of the last decade. Then they tried drawing things down. They tried this quantitative tightening, selling off assets from their balance sheet beginning in 2018. Now, in 2019, interestingly, the financial system started to show a lot of signs of stress. We saw surging borrowing costs in the Fed's overnight lending facilities. They had to start printing again. Then, conveniently for them, we had that little health crisis. I guess I can call it COVID now, and I'm not going to get censored for it. We had that little health crisis, which gave them the excuse to print trillions and trillions of dollars. We saw the balance sheet rise between 2020 from here, around $4 trillion, to almost $9 trillion mid-2022. And you know what happened when they did that? We saw record inflation. Maybe not record. I suppose that the 1970s saw higher inflation, but still very high inflation, the highest inflation in decades. And we're still living with that today, by the way. I mean, yeah, the rate of inflation perhaps has gone down a little bit. People like to tell me there's no inflation now in the economy. Well, we still have all the inflation from 2020 to 2022. None of that went away. We didn't have any deflation. That's why everything is still so expensive when you go to the grocery store. But then they tried this quantitative tightening thing again, right? And then what happened was you had the 2023 banking crisis. They had to start printing money again to kind of bail things out. Kept trying to draw it down. Now, they just announced in December that they are buying treasuries again, expanding their balance sheet. They said it's just to help moderate interest rates. It's only short-term treasuries. It's not QE. Well, QE is to moderate interest rates. That's the whole point, right? And it's interesting that they began doing this seemingly with no crisis, necessitating it. Well, they saw what was coming, right? They probably saw that there's a debt crisis incoming and they're trying to get ahead of it. But it looks like they weren't able to forestall that, and they're not going to be able to, because the way this works is once you start down this path of QE, you keep having to do it. You never are able to normalize your balance sheet without suffering a massive economic drawdown, because all the prosperity since 2008 has been an illusion. It's all based on fake asset bubble inflation, because you print a bunch of fiat currency. Everybody gets the quote unquote wealth effect where, your stock portfolio goes up, the value of your house goes up, but whoops, your grocery bill goes way up too. There's no real increase in wealth. You just have a bigger number on paper. And when you start trying to draw things down, then it collapses the whole thing. So what we're in the midst of now is a situation where they're going to have to print more money. It's just waiting for a pin to pop the bubble that we're in. And this is it. This is it. Today, this surge in Japanese bond yield, this is probably the pin. I mean, bookmark this video. You come back to it in a couple months and see how things have played out. But this is the canary in the coal mine here. And gold and silver are confirming this move, right? The whole precious metals complex. Look at platinum, up 5% today, probably breaking out of this triangle that it's been consolidating in. Palladium, testing its this resistance line, about to break out to the upside. The SILJ ETF, up 4.67% today, gapping up higher. Miners are confirming this move too. If this was just some kind of FOMO thing, some headline-driven fear, you would not see the miners confirming the breakout in the precious metals. The GDX, Senior Gold Miner ETF, gapping up today, up over 5%. Interestingly, look at Bitcoin. Bitcoin down below $90,000 once again. Maybe it's not the safe haven that it was touted as. Perhaps. Just something to think about. Smash that like button if you agree. Subscribe to the channel if you agree. Share this video if you agree. Go follow me on x.com/stacksmarter if you're getting something out of this, because things are really heating up right now and you're going to want to stay abreast with the latest information. Good way to do that is follow me. You'll get these infographics. I'll do my best to keep you updated with everything that is happening. But let's talk about why we are not set up to weather the storm like in previous financial crises. Okay, a lot of it has to do with the global political situation right now. So let's just look briefly at what markets are doing. Okay, all the major U.S. stock indexes are in the red today. Why? There's fear over tariffs again, right? This is, a repeat of things that we've seen playing out over the course of the past year. Global markets drop sharply as Trump reignites fear of trade war over Greenland. Some of this may be smoke and mirrors. I mean, who knows? But the president has threatened to hit 7 EU countries and the UK with tariffs unless they support his push for American control of Greenland. That some people will say, oh, you can't trust what NBC says. But I mean, look, that's just a fact. The president did threaten that, right? He's threatened to hit these countries with tariffs. And this is very important because in the past, when we have had global financial crises, like in 2008 and in 2020 and in 2023, there's always been this coordinated response by global central banks. They set up swap lines. They do everything they can to, quote unquote, normalize the situation and prevent the debt crisis from spiraling, because they kind of know that in the modern fiat era, all of these economies are interlocked. Like, look at Japan. They're having a debt crisis. They're a huge holder of U.S. treasuries, right? So there's no isolated economies. Unless you're like North Korea or something. The Western developed economies, at the very least, are all interconnected in the global economy. And so they have this coordinated response. But right now, there's this political fracturing that could very well impede a coordinated response to a global financial crisis, and this time it may spiral out of control. Now, what does that mean? It doesn't mean that they're going to default on the debt, but it could mean that the central banks really have to come with a heavy-handed response in the response that they do have and print vast sums of fiat currency, maybe even more so than they would not have needed to if there was more of a coordinated response available. This is based on a note that was written by an analyst at Deutsche Bank. This is important. Europe can wield this $8 trillion sell America weapon as Trump reignites a trade war over his Greenland conquest ambitions. This is from Fortune from yesterday, the 19th. And I'll just read you the quote here from George Saravelos, head of FX research at Deutsche Bank. He said European countries own $8 trillion of U.S. bonds and equities, almost twice as much as the rest of the world combined, in an environment where the geoeconomic stability of the Western alliance is being disrupted existentially. It is not clear why Europeans would be as willing to play this part. And going back to this chart from the Treasury, you can see the UK is the second largest holder of U.S. treasuries. And you got Belgium, then you got Canada, Luxembourg, France, Ireland, Switzerland. They're all on the list. Norway, Germany. So yeah, 8 trillion combined in these assets. Now, I don't think that they're going to dump their U.S. treasuries for political squabble over Greenland. That would sort of be like cutting off their nose to spite their face. because it would be disastrous for them. I mean, it's kind of a bazooka for, a petty squabble. But here's the thing. What if they stop buying U.S. Treasuries? That alone could cause a surge in U.S. Treasury yields. If the Europeans decide that, hey, maybe we should slow down our purchases of U.S. debt. Oh, I got some old stuff on this chart. Let me get rid of that. Live stream's fun. So this is the yield on the, what is this? This is the 30-year U.S. Treasury, and it's not at a high for the past several years. You can see this went over 5% back in May, but that was during the original tariff issue affecting markets, whatever you want to call it. That was when President Trump said, what was the word he used? He said that the bond yield was, or the bond market was getting a little, he said like squirrely, or I don't think that's a direct quote verbatim, but he said that the bond yield was getting a little jumpy, maybe, or uppity, something like that. He said there was a problem, right? And it is, because again, we've got $38.6 trillion. We roll that debt over all the time. And if U.S. bond yields go higher, well, that means that the cost to service that debt is going to be rising. And again, it's already over $1 trillion. Pretty soon, servicing the U.S. debt is going to be the biggest item on the federal budget. And that's a big problem, right? And again, you can see that this is gapping up today. So if European countries decide, hey, let's fight back a little bit, let's put some pressure on the U.S. economy, all they got to do is stop buying U.S. debt, and you're going to see bond yields here rising more than they would otherwise, right? Because remember, bonds, the yields go down when buyers come into the market. If buyers step out of the market, you got to raise yields. Yields have to go higher to incentivize new buyers to come in. Like if no one's buying your 30-year treasuries, then the yield needs to get higher. Now, the one exception to that is when your central bank buys the bonds, which is what we've done in previous financial crises, right? We've had the Fed buy treasuries with printed currency, but that's why the dollar is so debased. But this crisis is happening at a time when collective worldwide debt is at a record high, right? That's the thing. I mean, the debt keeps growing, and every time you get a financial crisis, it's at a higher level. It means more money or currency needs to be printed. Now, this couldn't come at, I don't know if you want to say a worse time or a better time for the precious metals. I mean, look at what silver is doing here, right? It's been consolidating, breaking out, consolidating. Today, it gapped up, right? Looks like another breakout here. From a technical standpoint, what we would expect to see is another flagpole in silver. These moves up are called flagpoles, right? And then you get the flag that forms the consolidation as the market digests these rapid moves up. So I think you can expect the silver price to continue rising as this debt crisis plays out. And it's very possible that there will be an announcement at some time that the Japanese central bank is facing a crisis, right? They don't want to print money. So Japan may begin selling its U.S. treasuries. If that announcement occurs, I mean, this is what's going to happen. A huge spike up in the dollar-denominated price of silver, a huge spike up in the dollar-denominated price of gold on that announcement. And it's, again, I can't give financial advice. I'm not telling anybody what to do. It depends on your situation, right? If you got a bunch of credit card debt or something like that, pay that down. Don't buy physical bullion. Do your own research, do your due diligence. But for me, at least, I want to be fully positioned in physical metals and whatever derivatives, miners that I want to hold to take a little more risk to benefit from that. Because, I mean, this is a terrible thing for everybody, right? If your country goes through a hyperinflation, if the global economy, if the debt bubble bursts, that's not good for anyone. But you're going, you get the economy that you get, not the one that you hope for. So you've got to get prepared to protect yourself, right? Some people will say, when I say, oh, stack gold, stack silver for what's coming, they say, well, if you see gold at $10,000, that means, a loaf of bread's going to be $50. Okay, yeah, maybe. So I'll be glad to have the gold so I can still buy a loaf of bread, right? Instead of my fiat currency, where now I'm going to be eating, cat food. right? It's like you might not get rich from owning gold and silver, even though the nominal price is rising, but at least you didn't lose everything to an inflationary inferno that debases the currency. So, look, it's also possible that this move awakens the masses to what is occurring, and you may see gold and silver not just having nominal price increases, and this is what I think is going to happen. You're going to see them actually increase in terms of their purchasing power, right? So other assets like, who knows, housing, the S&P 500, the Dow Jones, the NASDAQ, Bitcoin, cryptocurrency, you name it. All of those things may very well likely decline in terms of their purchasing power versus silver. So, millionaires, wealthy fortunes are built during crises more than any other time in history, right? There were more millionaires created in the Depression than any other time. I mean, millionaires now doesn't mean anything, I guess, because everything's so expensive, right? Like you could live in an average house in a big city and you're a millionaire, right? Because your house is ridiculously overpriced. But look, I mean, there will be a time to convert gold and silver into other assets. I suspect that time, will come. And look, if you want to know when it's going to be, subscribe to the channel. I'll do my best to keep you up on these things. But right now, I think even with the metals at record all-time highs, they're still the best game in town. And you can see how this is going to play out, right? As the global debt crisis worsens, you're going to see more moves like this. I mean, gold, this is technically just such a entry signal. This breakout from consolidation, new record all-time highs, gapping up higher, surging yields on the debt of the biggest holder of U.S. Treasuries. I don't know how to spell it out anymore. Do me a favor. Share this video with your friends. Follow me at x.com/stacksmarter. Check the link in the description of this video. You can sign up for my free newsletter. And a lot of people who watch these videos, they don't subscribe to the channel. If you got any value from this and you think that this is information that you'd like to, continue receiving updates on, click the subscribe button, click the bell notification icon, and do me a favor, leave me a comment down below to let me know what you think about the topics that we covered in today's live stream, because I think that today is going to be potentially a day that lives in economic infamy as this crisis plays out. People are going to look back at this day and say, oh, that was when it all started, right? Japanese bond yield surging 8% in one day. That was the sign that the crisis really was on. And I think that, we may be there. But anyway, thanks for watching, everybody. Stay safe and happy stacking. I'll catch you next time. Smart Silver Stacker out.